In 2025, a basic Ford truck can now cost more than an entire house did 10 years ago, and they're not even trying to hide it. Right now, dealerships across America are asking $162,000 for loaded F-150s. That's not a Raptor R, not a concept truck, just an F-150 with bolt-ons, badges, and a lift kit priced like a Bentley. The average full-size pickup? Now $74,000. That's up 46% since 2020. And despite record-high interest rates and shrinking household budgets, Ford just reported record earnings while their lots are packed with unsold inventory. So how is this happening? And why are manufacturers pushing trucks that cost more than 3 years of college tuition when most Americans can barely afford groceries? It's not inflation, it's not supply chains, it's not even the features. The answer is far more calculated. Ford and other automakers have abandoned the volume model that built the American middle class. They're now deliberately chasing luxury margins, even as dealers choke on inventory they can't move. What most people don't realize is that Ford makes more profit selling one truck for $160,000 than 4 trucks at $40,000 each. But this strategy is creating a dangerous bubble that's about to burst, and the evidence is hiding in plain sight in Ford's own sales figures. So what's really happening in the truck market, and why do prices keep climbing despite clear signs the strategy is failing? The answer lies in what economists call channel stuffing, and it's happening on an unprecedented scale. Ford reported selling over 200,000 F-Series trucks last quarter, their best performance in 3 years. Yet dealerships across the country are packed with inventory they can't move. This contradiction isn't accidental. It's the result of a perfect storm that began earlier this year. When the Trump administration announced potential new tariffs on imported vehicle components in January, consumer demand surged as buyers rushed to purchase vehicles before expected price increases. Dealers quickly emptied their lots, creating what appeared to be a boom market. In response, they placed massive orders with Ford, who happily filled those allocations. Fast forward to today, and those same dealerships are now sitting on hundreds of high-priced trucks with no buyers in sight. The pulled-forward demand created an artificial sales spike for Ford that looked great on quarterly earnings but has left dealerships in a precarious position. Industry insiders reveal that many dealers are now refusing additional allocations, but the damage is already done. What makes this situation particularly concerning is that Ford's manufacturing margins have been shrinking. The latest earnings report shows a 2.8% decrease in per-vehicle profit margin compared to last year. This means they have less financial flexibility to offer incentives or discounts that might move this excess inventory. This inventory problem becomes even more alarming when you look at specific models. Take the Ford Lightning, their all-electric truck that was supposed to revolutionize the pickup market. Despite billions in development and marketing, the average Ford dealership sells just one Lightning per month. With sticker prices approaching $90,000, these vehicles sit on lots for months, representing a significant capital investment that isn't generating returns. This isn't just a Ford problem, it's industry-wide. But Ford's situation is particularly notable because of their heavy reliance on truck sales for overall profitability. While brands like Toyota can offset truck inventory issues with strong passenger car sales, Ford's business model is much more vulnerable to shifts in the truck market. What's truly shocking is how quickly manufacturers pivoted to this high-margin strategy. In 2020, at the height of the pandemic supply chain crisis, dealers were selling vehicles at or above MSRP out of necessity. But when consumers reluctantly accepted these prices, manufacturers saw an opportunity to permanently reset pricing expectations. The strategy worked brilliantly during the inventory-constrained years of 2021 through 2023. With limited supply, consumers had little choice but to accept whatever was available at whatever price dealers demanded. This created the perfect environment for automakers to test just how high they could push prices before meeting resistance. Ford led this charge with their truck lineup, systematically eliminating lower trim models and focusing production on high-content, high-margin variants. They introduced increasingly expensive special editions and appearance packages that added minimal functional value but significant cost. The Black Widow package, Harley-Davidson editions, and custom lifts that pushed prices into 6 figures. The data shows just how dramatically this shifted the market. In 2019, only 3% of Ford F-150 sales were priced above $70,000. By early 2025, that figure had jumped to 28%. This wasn't just inflation, it was a deliberate strategy to move their core product up market. For a while, this approach delivered record profits. Ford's per-vehicle profit peaked in 2022 at over $10,000, more than double their pre-pandemic average. Wall Street rewarded this strategy with stock price increases and analyst upgrades, creating a powerful incentive to continue pushing up market regardless of the long-term consequences. But the market is now showing clear signs that this strategy has reached its limit. The average F-150 now sits on dealer lots for 68 days before selling, well above the 40 to 50-day industry target. For models priced above $80,000, that figure jumps to 82 days, indicating waning demand for these ultra-premium trucks. The implications of this pricing strategy extend far beyond just Ford's bottom line. They're reshaping the entire automotive landscape in ways that could have lasting consequences for American consumers. What we're witnessing is the end of the volume-based business model that has defined American auto manufacturing for over a century. Since Henry Ford pioneered the assembly line, the automotive industry has operated on a fundamental principle: maximize production volume to achieve economies of scale, which allows for affordable pricing and broad market reach. This approach built the American middle class and made car ownership accessible to nearly everyone. Today's strategy inverts this model entirely. Rather than selling many vehicles at modest margins, manufacturers now prefer selling fewer vehicles at extraordinary margins. This shift began during the pandemic when supply chain constraints limited production. But what started as a temporary adjustment has now become the preferred business model. The stakes for consumers couldn't be higher. As manufacturers focus on high-margin vehicles, they're systematically abandoning the affordable segments of the market. In 2015, 23% of new vehicles sold in America were priced under $30,000. Today, that figure has dropped to just 7%. The entry-level new vehicle is vanishing before our eyes. For the average American household with a median income of $71,000, the recommended maximum vehicle expenditure should be around $35,000. Yet the average new vehicle transaction price now exceeds $48,000, with trucks and SUVs pushing well beyond that. This creates a market where new vehicles are simply unaffordable for the majority of Americans. This affordability crisis is compounded by the fact that as new vehicle prices increase, used vehicle prices follow suit. The traditional relief valve for budget-conscious consumers is disappearing, creating a cascade effect through the entire automotive ecosystem. The result is longer loan terms, higher default rates, and a growing transportation inequality gap between economic classes. The average loan term for new truck purchases has now stretched to 72 months, with 28% of loans extending to 84 months or longer. These extended terms mask the fundamental unaffordability of these vehicles, creating the illusion of accessibility while actually trapping consumers in negative equity positions for years. But the most alarming aspect of this situation is what it reveals about the fundamental disconnect between Wall Street and Main Street. Ford's stock price increased by 6% after their last earnings report, despite clear evidence that their current sales strategy is unsustainable. Investors are rewarding short-term profit margin increases while ignoring the building inventory crisis at dealerships nationwide. Here's where things get interesting, and what most industry analysts are missing. The current inventory buildup isn't just a temporary imbalance. It's the leading edge of a major market correction that could reshape the entire industry. The twist in this story is that Ford actually has the solution to their problem sitting right on their own lots, but they're deliberately choosing not to emphasize it. Their commercial vehicle lineup tells the real story. A 2025 Ford Transit cargo van with a sticker price of $56,000 isn't a stripped-down penalty box. It's a capable, well-built commercial vehicle with a reasonable price tag relative to its utility. What's most telling is that Ford's commercial vehicle division is actually performing exceptionally well. Fleet sales increased by 23% year over year, representing one of the few bright spots in their overall sales mix. These vehicles maintain healthy margins while providing genuine value to businesses that depend on them. This reveals the fundamental contradiction in Ford's current strategy. They have the manufacturing capability, distribution network, and engineering expertise to produce vehicles at reasonable price points. The Transit proves this. Yet they've deliberately chosen to push consumer trucks into luxury car territory, betting that enough buyers will accept these inflated prices to make the strategy worthwhile. The data suggests this bet is now failing. Dealer inventory reports show that trucks priced over $80,000 are sitting on lots an average of 82 days before selling, well above the industry target of 40 to 50 days. Meanwhile, the few reasonably priced models are turning in under 30 days, indicating strong demand for vehicles with sensible pricing. What's particularly revealing is what's happening with dealer incentives and factory support. Ford has begun quietly increasing dealer incentives on high-end models, effectively discounting these vehicles while maintaining the fiction of high MSRPs. This allows them to preserve the perception of premium pricing while actually selling at lower transaction prices, a classic sign of a pricing strategy that's failing in the marketplace. Industry insiders report that the unofficial dealer discounts on loaded F-150 models now range from 12 to 18% off MSRP, representing potential reductions of $15,000 to $25,000 on high-end models. Yet these discounts aren't being advertised widely, as doing so would undermine the premium pricing strategy Ford has invested so heavily in establishing. This hidden discounting reveals the fundamental weakness in the current pricing model. It's a strategy built on the assumption that American consumers would permanently accept paying luxury car prices for pickup trucks. That assumption appears increasingly shaky as economic reality reasserts itself in the marketplace. And here's the real kicker. Consumers don't even want many of these premium features that are driving prices higher. When dealers do offer more basic trucks with fewer features at lower price points, they sell quickly. Sales managers across the country report that these unicorn basic models often sell within days of arriving on the lot, while their premium counterparts sit for months. But here's the problem. Manufacturers have deliberately reduced production of these more affordable configurations, creating artificial scarcity that forces consumers toward higher margin models. It's a strategy that worked in a supply-constrained environment, but is failing spectacularly as inventory levels normalize. A Ford truck shouldn't cost more than your house. The current pricing strategy that has pushed pickup trucks into the six-figure range isn't just unsustainable, it represents a fundamental betrayal of the values that built the American automotive industry. These vehicles were designed to be tools for work, recreation, and family transportation, not status symbols with price tags rivaling luxury European imports. The data clearly shows we're reaching a breaking point. Ford dealerships across America are now sitting on record inventory levels of high-priced trucks they can't sell, even as the manufacturer reports record quarterly results. This contradiction can't continue indefinitely. Something has to give. The good news for consumers is that market forces are already beginning to correct this imbalance. Dealer discounts are increasing, financing terms are becoming more favorable, and manufacturers are quietly reconsidering their product planning to include more affordable options. The pendulum that swung so dramatically toward high-margin, low-volume products is beginning to swing back toward the middle. For potential truck buyers, this creates both challenges and opportunities. The challenge is navigating a market where official pricing has become almost meaningless, with the actual transaction price determined more by negotiation skill than MSRP. The opportunity is that substantial discounts are available for informed buyers willing to look beyond the sticker price. The bigger question for the industry is whether this correction will happen in an orderly fashion or through a more disruptive process. The data suggests we're approaching a tipping point where inventory carrying costs will force dealers to make dramatic price adjustments regardless of manufacturer preferences. When that happens, the fiction of the six-figure pickup truck may finally be exposed for what it is, a temporary aberration rather than a new normal. Ford trucks costing more than houses isn't just ridiculous. It's unsustainable, and the market is already beginning to deliver that message loud and clear, regardless of what the official sales figures might suggest. While manufacturers may have briefly convinced themselves that American consumers would accept luxury car pricing for pickup trucks, the growing inventory on dealer lots tells the real story. The correction is coming, and for anyone who believes in vehicles that deliver actual value rather than just status, that's very good news indeed.